US stock market could be in bubble territory already. Hi, everyone, and welcome to Ainslie Insights, brought to you by Ainslie Bullion, Ainslie Crypto, and the Gold and Silver Standard as the Ainslie Group celebrates 50 years. Today, we're welcome back Branko, who, even against this backdrop of all-time highs, we've had all-time highs in Bitcoin and gold. It's been a very exciting time here. We've got some concerns on the horizon when we start looking at the US. How are you going today, Branko?
Good, good. I think this kind of ties into some of the all-time highs we're seeing in gold and Bitcoin as well. So a lot of glamour in the news as well, but just worrying signs about equities and how that kind of relates to gold and Bitcoin moving forward.
Absolutely. And that's what we might start off on today. What did you think? Because in the article, you sort of laid out a bit of a case that the US stock market might be entering a bubble territory, similar to what we saw in the dot-com era. What sort of led you to that belief?
Yeah, so there were a few factors, overinflated asset prices. To kind of get into it a bit more in depth, you've got higher PE ratios than normal, and there's a bit of a comparison that we can put up on screen that compares those to the dot-com bubble. So that's kind of the first point. I mean, one of the famous ones of the internet, when those first internet stocks came out, with these just ridiculous PE ratios, and we actually have more of those. Well, not more. The average was higher then. We have more
Mm.
extremes today. And then the second one was this idea of, when households start getting in like the equity game and buying up assets, generally they're the last to enter at a bull market. We have a high percentage of those people buying. And the third one is this idea between S&P dispersion and volatility. So when there's like a growing difference of a certain sector and its volatility, it implies that in the event of a downturn, because of the high volatility, it can be, have a more aggressive move to the downside. And we kind of saw that in the dot-com era as well. So they're kind of the three things and to kind of go into. So there are some similarities. And then again, I think given how Bitcoin and gold are moving, I think there's a very interesting dichotomy between all these assets at the moment.
Yeah, for sure. And I'd like to just dig into one of them in particular that you talked about there, and that's his valuations aspect, because that's something. And you made this point really well in the article, I thought, that it doesn't mean necessarily because the valuations are high that we are in a bubble. But
Yeah.
certainly when you look at that historical sort of comparison, and that's history might be rhyming, it might not be repeating, but if you look at this historically, you would argue that the valuations are very high. So do you think there are some implications from that this has for future returns? Like, should we be concerned about that? Is that really the point that you're trying to make?
Yeah, I mean, again, on its own, I think a high PE valuation doesn't really mean much, but combined with other factors, it is a concerning worrying. When you have, for example, all of the AI stocks right now, obviously have very high PE ratios because it's a very exciting sector. And again, on its own, not that bad. But when you have a large, as you can see in the graph, it's like very large right tail where it's like you have these crazy PE ratios of like 70 and 80,
Hmm.
and that's a lot more than the dot-com bubble at that number. That can be concerning. Again, even though the overall average PE ratio was about 30 at the time of the dot-com bubble, and now it's 25. These extremes are kind of very concerning that we're seeing right now. So on its own, is a PE ratio the end of the world? Not really. But I think in the current environment is a bit of a sign.
And that's a really good explanation because you're not saying individually, you're looking at that collectively. I think that is important when you look at that average and say, well, the average is out of whack. That's what we should be paying attention to. And the other bit there, I'd like to just dive into a little bit more is that household sector stuff that you were talking about. Because, I mean, you've spoken a lot about the household sector in the last, several months, really, when we've been discussing various factors and you were quite concerned about the household sector. But this is looking at it from a slightly different angle and talking about their investment patterns potentially leading to that bubble. And certainly it seems like there's a lot of narratives driving this market. So have you got any sort of additional aspects that you could enlighten us on there in terms of the household sector specifically?
Yeah. So basically, to sum this up, the old adage of like, hey, the taxi driver gave me a stock tip. It's time to get out of the market rings true for a reason.
Yep.
Because then two people are in a market and people that are generally not interested in financial markets, and we saw it in crypto as well, right? When everyone's buying and retail always buys at the top and gets wrecked, right? So you can kind of compare, okay, well, what percentage of like you have what households spend on financial assets, what percentage of that is going to equities?
Mm.
and that is at close to a recent high, that is very similar to 2000 before the crash. So it is very high right now, and when you combine that with the high PE ratios, it's starting to paint a picture of potentially an overvalued market, and it is a bit worrying. But just the general idea of like retail generally like will be the last to exit is probably best explained through this graph and makes sense in this situation.
So I suppose that leads us to the culminating question here of what can you do as an investor to take, like what steps can you take to protect yourself from that risk? Because I know we've seen these highs in gold and Bitcoin, and I know like we look at them as monetary inflation hedges. So, protecting against money printing and things that are going on, but also has that role potentially in downturns. Is that how you see it? And if you're looking specifically at those as assets, is it too late? Are you too late to the party to think about diversifying here?
Yeah, well, I think that a great way to diversify and kind of hedge your risk if you have equities is to buy gold and Bitcoin. I mean, I think Bitcoin's probably the most exciting just for me right now because you kind of saw the run up when everything was running up back in the COVID era, right? When everyone had the stimulus and there was so much money being pumped into the system. Obviously, Bitcoin and stocks kept flying. But now we're seeing the hedge impact of crypto, and it's kind of more correlating with gold. So I think that both assets represent a good hedge to anyone's, stock portfolio. And we're kind of seeing that in the evidence of how the money flow is right now. People are potentially moving out of equities into these other assets. So I think it's a good strategy if you want to hedge your risk in the share market right now, for sure.
Absolutely. And I think even though we're at those highs, I'm sure you would agree with me here, when you look at why we're at those highs, it sort of puts it into perspective because when you look at simply the amount of money that's being pumped into the system and the speculation that's coming from these other assets, just because we're at all-time highs doesn't mean that we're not breaking out into a pattern that heads much higher. And I know, when you're specifically talking about gold, that's been in that cup and handle pattern that it's only now breaking out of that's been in for over a decade. So very, very long-term patterns it takes to build up this momentum. And when the momentum does break through, it can be quite spectacular.
And then one more thing I add is as well, you've got obviously the Bitcoin ETF, which was a big driver of this recent price movement. And that is kind of a direct example of potentially funds saying, do you want to put it in equities or do you want to put in this Bitcoin ETF? And clearly they're choosing the Bitcoin ETF given how they're moving at the moment. So, even large funds are potentially pivoting as well as a relocation of their assets.
So do you think, just one last question on that, do you think that maybe this is potentially a turning point for those assets where they become uncorrelated to what's happening in the share market? Because we have seen a bit of correlation, just going up with the market and down with the market, that we now break out of that.
Yeah, I don't think we're going to completely break out of it, but I think it's going to start to break out for sure. But I don't think, if equities go down some crazy day, like 5-6%, I do think crypto will go down. But it could be the starting point to break out of that correlation between the two.
Yeah, very interesting. Well, thank you so much for your work on that today, Branko. Really appreciate it. Lots to think about there, and we'll keep an eye on those markets. And for the moment, we'll just enjoy those all-time highs.
Sounds good. See ya.
Thank you very much. Thanks, everyone, for watching. We'll chat again soon.